Well, it's still called the Secure Act, but now it's the law. Passed by the Senate in December, the Secure Act is the first major update to retirement planning laws and guidelines in almost 15 years. So, are you ready to take advantage of new opportunities? It's time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. If you're a regular viewer, you know that we've been following the Secure Act as it's made its way through the legislative process. SECURE is an acronym for Setting Every Community Up for Retirement Enhancement. And unlike most things in Washington these days, the bill has had a fair amount of bipartisan support. The Secure Act is basically the government's response to a variety of new issues and new challenges that are related to retirement planning. Everything from longer lifespans to the burden of student loan debt. On today's show, we'll break down some of the most significant changes you should know about, particularly if you're already retired or within 10 years of retirement. We'll look at how the Secure Act impacts your required minimum distributions, your ability to contribute to and withdraw from your retirement accounts, and the potential new opportunities that it creates to help ensure that you have reliable income throughout retirement. And joining us today will be Greg McBride, Senior Vice President and Chief Financial Analyst for Bankrate.com, along with Alex Ayers from AMAC, the Association of Mature American Citizens, known as the conservative alternative to AARP, and Brad Williams, the owner and president of Brad Williams Financial Services, a retirement income store in Huntsville, Alabama. And in addition to that, we're also introducing a new feature today that gives you an opportunity to join the conversation. At any point during the show, you're invited to submit your questions or comments on this important topic, or any financial planning issue for that matter, via telephone or email. Then we'll respond to your input later in the show. But before we bring in our first guest, let's take a quick look at a couple of the Secure Act's most important changes for Americans in or nearing retirement. The first major change is one that we've already mentioned on a previous show. Effective this year, the Secure Act raises the age at which you must start taking required minimum distributions from 70 and a half to age 72. As you know, RMDs are minimum amounts the IRS requires you to withdraw annually from your IRAs and from other qualified accounts once you reach that magical age. This change means that you will now be able to let your retirement funds grow tax deferred for an additional year and a half. One important note here, if you've already turned age 70 and a half in 2019, the new law does not apply to you and you must take your first distribution by April 1st of this year. It only applies if you're turning 70 and a half after January 1st of 2020. This is one provision in the Act that addresses the simple fact that life expectancies are longer than ever before, meaning that people must plan and save for longer retirements. Since people are living longer, that also means that many are also choosing to work longer, which is why the Secure Act also has removed age limits for contributions to traditional IRAs. Previously, an individual was only able to contribute to a traditional IRA up to the age of 70 and a half. Only Roth IRAs did not have an age limit for contributions. However, starting this year, any individual who still has earned income may contribute to a traditional IRA or a spousal IRA for as long as he or she would like. That is earned income from employment, even if you have not contributed to an IRA in the past. One more noteworthy change I'd like to mention is that starting in 2021, the Secure Act will make employer-sponsored retirement plans available to long-term part-time workers. Prior to the new law, employers were not required to offer those who worked less than 19 hours a week access to their sponsored plans. The Secure Act lowers the threshold for eligibility to roughly 9.5 hours a week, which could be a great benefit for older workers who want to continue working on a part-time basis. Later in the show, we'll talk about one of the more controversial provisions in the Secure Act and how it may impact you. Now it's time to bring in our first guest, Greg McBride. He's the Senior Vice President and Chief Financial Analyst for Bankrate.com. He's appeared on hundreds of national cable and television networks, including NBC, CBS, CNBC, Fox Business. Greg, thanks so much for being here today.
Thanks for having me.
So we're talking about the Secure Act. Net, do you think the Secure Act was a positive thing? Do you think it's a negative thing? Give me your take on it.
Yeah, I think it's a positive because it does reflect the changing nature of retirement, and specifically longer lifespans and working later in life, even if that's on a part-time basis. A couple of provisions I think really speak to that, raising the age for required minimum distributions to age 72 and removing the age limit on contributing to a traditional IRA. Both of those, I think, reflect the new reality of retirement.
Sure. And I talk a lot about when you get to the age of RMDs, in an ideal world, you want to earn enough interest and dividends if you can, to be able to take those RMDs from interest and dividends, at least in the early years, and not have to spend down principal. So by going out to age 72, it essentially gives people a little longer time to make that transition, correct?
Yeah, absolutely. It gives your money a little bit longer to compound. And it's also less time over which you're going to be drawing that out. And, for so many people that have a shortfall of retirement savings, that year and a half difference can really make a big difference.
Now, it's interesting because we're talking this week, and we just came off of a heck of a week in the stock market, a heck of a week with interest rates. The 10-year Treasury yield, the interest rate on the 10-year government bond, that is, actually got lower than it was during the peak of the financial crisis. So here we are during the financial crisis, this great flight to quality, if you will, because of people being concerned. And now there's even a bigger flight to quality. And the coronavirus really isn't anything compared to the financial crisis. So 45 seconds, so what do you make of what we're seeing right now with interest rates?
Well, markets hate uncertainty, and right now there's a ton of it because of the coronavirus. That's kind of newly charted territory. And so it's not surprising to see a stock market correction in the face of that. Also, interest rates coming way down, but keep in mind in a global context, our interest rates still much higher than a lot of other developed markets.
Yeah, it always makes me, in fact, I want to ask you right after the break, your thoughts about that as a fellow CFA. It seems weird to me that we can go ahead and buy Italy bonds and actually earn more interest than we can or earn less interest than we can on our own U.S. government bonds. So we'll talk about that coming up right after the break. You stay with us, take a quick commercial break. We'll be right back with more words of wisdom from our new friend, Greg McBride. We'll be right back. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more. Let's talk more about the Secure Act. Another change in the Secure Act might be seen as an acknowledgement of a point that we stress constantly right here on this show, that the key to a successful retirement can be summed up in one word: income. The new law includes several provisions allowing for the inclusion of more lifetime income products in retirement plans. See, before the Secure Act, some employers may have been hesitant about including income products such as annuities in their sponsored plans for liability reasons. However, the new law provides employers with immunity so long as the providers of their income products meet certain requirements. The Secure Act also makes income products portable between retirement plans. For example, if you change jobs, it is now possible to roll over a 401k annuity from your former employer to another 401k or IRA without incurring the surrender penalties for early withdrawal. In addition, the Secure Act will require new disclosures about how your retirement savings might be different if you were invested in a lifetime income stream product. Specifically, the law requires that defined contribution plans deliver a disclosure document showing the, quote, lifetime income stream equivalent, close quote, that could be generated by the lump sum amount in your retirement account. While these are welcome changes, of course, always remember that true investing for income is a highly specialized area of financial planning, and that creating a sound overall strategy for reliable lifetime income is best done with the help of a financial advisor who specializes in income-generating products and strategies. Welcome back to the Income Generation, and let's welcome back also our new friend Greg McBride, Senior Vice President and Chief Financial Analyst for Bankrate.com. Greg, thanks for sticking around.
My pleasure. Thanks.
So again, what do we make of this? You know, when you go to a country whose debt is theoretically riskier than ours, and you could say Italy, Spain, you could almost fill in the bank with some European countries, but yet our bonds are still paying more interest than theirs. How do you make sense of that globally?
Well, a lot of this boils down to economic growth. Right now, the U.S. economy is growing at a much faster pace than most, if not all, other developed markets. And as a result, the interest rates in those economies are much lower. Their central banks may have negative benchmark interest rates. Ours, by comparison, much higher than that. And to your point, Greece, believe it or not, their 10-year government bond actually yields less than 1%. So below the top credit quality U.S., again, a reflection of the strong relative economic performance we've seen here in the U.S.
And it wasn't that long ago we were talking about whether Greece was even going to repay their debts at all, and yet their yield is lower than ours. It's amazing. So banks, today, if I want to go buy a 5-year CD or a 10-year CD, what's the best rate that you've seen through an FDIC-insured bank these days?
Yeah, right now on CDs, really of all maturities, there's not a big difference in yield. So you're not rewarded for going out, stretching out into longer maturities. Yields are in the low 2% neighborhood, 2.1, 2.2, maybe 2.4 if you stretch all the way out to 5 years. Again, all you're really doing, I think, is locking yourself in at a rate that may not even keep pace with inflation. Right now, I think the real sweet spot, very short-term CDs or online savings accounts, having that liquidity so that you can, capitalize on opportunities as they present themselves, and you're not giving up much yield to have that flexibility.
But the only problem with the short term is a lot of people would say, and I'm one of those, that we have a new norm of permanent low interest rates, that if the economy's doing well and our rates are this low, imagine what happens in the next recession. We could even see negative short-term rates here in this country. So 30 seconds, how do we combat against that in the future if interest rates go even lower or are negative, and this is the new norm?
Yeah, well, I agree. I think that, in a global context, we've got a lot of developed markets that have aging populations, slow economic growth, low interest rates, and even negative interest rates are going to be around for a while. I don't really like bonds for that reason, because if there's even a slight uptick in interest rates, you can take big losses. Dividend-paying stocks may be the way to generate income for a lot of retirees.
As long as the stock market holds, I guess we have to cross our fingers and toes and hope that we don't get a socialist in the White House. But assuming not, maybe it'll hold for a bit. Listen, Greg, thanks so much for being on the show. Really appreciate your time today. One area of the Secure Act that has prompted a lot of discussion as well as some concern are changes to the rules around so-called stretch IRAs. Previously, a non-spouse beneficiary who inherited an IRA was able to draw down the account over his or her lifetime and defer paying taxes on the entire amount. So, a stretch IRA is really a strategy to stretch the period of tax-deferred earnings within an IRA beyond the lifetime of the person who set up the account initially. Typically, over perhaps even more than one generation. In other words, stretching it would allow you to pass the IRA down to your grandchildren. However, the Secure Act now requires that non-spousal beneficiaries, such as a son or daughter, draw down the assets in an inherited IRA within 10 years of that inheritance. There are no RMDs within the 10-year period, but the change is likely to introduce new tax burdens for people who inherit an IRA while still in their peak earning years. The new law also applies to funds inherited from a 401k or any other type of defined contribution pension plan. Now, there are some exceptions to the rule, which include assets left to a surviving spouse, a minor child, a disabled or chronically ill individual, as well as beneficiaries who are less than 10 years younger than the decedent, such as a sibling or maybe a friend. If the beneficiary is a minor, the exception only applies until the child reaches the age of majority, at which time the 10-year rule would then kick in and begin to be applied. Now, if you inherited an IRA from someone who passed away prior to January 1st of this year, then your inheritance is not subject to the new 10-year restriction, and you may continue with your planned distribution schedule without any fear of a penalty. If any area of the Secure Act has been met with criticism, it's been this rule change around stretch IRAs, which essentially eliminates it as a financial planning strategy. The good news is that the right advisor can potentially help you find ways to minimize the tax burden on your beneficiaries. They may be able to actually help you find alternative strategies for leaving a legacy while also ensuring that you have reliable income to meet your own retirement income needs and goals. Now, some other changes in the Secure Act that are worth mentioning include new provisions for taking tax-free distributions from retirement accounts for birth or adoption, and to pay off student loan debt, which is an issue today even for many older Americans. Don't forget, we'll be answering your questions on today's topic and other issues a little bit later in the show, so make sure that you give us a call or send us an email, and you might hear your question or comment answered right here on our show.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementincomestore.com.
Now it's time to welcome our next guest, Alex Ayers from the Association of Mature American Citizens, known as the conservative alternative to AARP. Alex, thanks so much for joining us today.
Yeah, thank you for having me on.
So, for those of our viewers that aren't familiar with AMAC, as I would refer to your organization, just take a moment and tell us what you're all about.
Yeah, so as you said, we are the conservative alternative to AARP, and in fact, we're the largest really alternative. We have about 2.1 million members nationwide, and so we're very similar in a lot of ways to how AARP works, where it's a member benefit organization. But really a lot of what we do is focusing on how we can make not only the lives of seniors, but all Americans better. So focus on lots of different issues here in D.C., but also providing those benefits that we know a lot of members are looking for.
So what are some of the major issues that you're focusing on today on behalf of your members, or maybe things that for which you're advocating?
Yeah, so being a seniors organization, there's the kind of the obvious, the Social Security, Medicare, and general health care. But then also on top of that, we do a lot of issues that are important to our members. Everything from healthcare costs to lowering taxes, even things like helping veterans with PTSD. So really, we are a member-driven organization in that way, finding the issues that our members do care about, and then trying to find the common sense solution on a lot of those issues to make sure that we're not trying to do anything that either drastically increases the size of government, but then still helps everyday Americans.
So for your members then who are trying to plan for retirement, let's say, and that are part of the income generation, they're over the age of 50, what types of educational resources does your company provide that can help them?
Yeah, so one of the great things that AMAC provides is actually called the AMAC Foundation. This is for anyone that is a senior looking at retirement or already retired. They don't even have to be an AMAC member, that they can use this as a resource to look at everything from Social Security, where we have national Social Security advisors on staff. But then we also put out promotional materials for trying to identify, things like identity theft or making sure that your investment advisor isn't trying to steer you in the wrong direction.
So we're talking today, of course, in the show about the Secure Act. So as advocates, when the Secure Act was just that, an act, not before it became law, were you guys behind it? Were you opposed to it?
So the Secure Act is, one of many retirement savings bills that we were tracking because it is an important issue to our members. So as it made its way through Congress, we delved into the bill and found all the parts that we liked and some of the parts that we didn't like. It's pretty common when you have these very large pieces of legislation that there's a mixed bag. It's whether or not the good outweighs the bad, but overall we did support the bill.
So net, it was more positive than negative in your opinion?
Absolutely. There was a lot of good provisions in there. Things, say, for the retirees that are already retired, things like extending the cap for when you have to start taking required minimum distributions from 70.5 to 72. Also eliminating the cap on contributions to IRAs for folks over age 70.5. Things like that were really good. But then for the folks that aren't retired yet, especially on the small business side, there were some pretty good provisions. Things like auto enrollment incentives for folks to get into retirement plans, multi-employer plans, so that way many small businesses can band together to form a single retirement plan that has the lower overhead costs to help make sure more of that money is going into the retirement fund.
Mm-hmm. Sure. That's great for people who work for small companies, without question. So give me an example of something right now that is about to go through Congress at some point in 2020, or at least is suspected to, that you folks are proponents of.
So there's several good bills out there relating to healthcare and retirement. Senator Portman has a bill that actually takes a lot of the good things that were in the Secure Act and takes them even a step farther. But one of the big things is that we are in 2020 and it's election year. So what can get passed while, kind of the politics of DC ramp up is a really big question mark.
We have 1 minute left. Where do you think is the area that Congress needs to focus on the most in order to help our retirees or those that are about to retire in the next 5 or 10 years? What's the area that they should be focusing on right now, in your opinion?
Oh, absolutely. Healthcare costs. Unfortunately, over the next year, because like I said, it's an election year, we're going to see two very different ideas going forward. A lot of them putting out by the progressives that are running for president is a massive change from our current healthcare system. Whereas the president is looking for more transparency, more free markets, things that really do and have been proven to bring down costs. So I would encourage everyone to take a look at those plans that are out there, not just read kind of the talking points by the candidates, but actually look at the plans to see what's going to be best for them in retirement.
So if I were to have my production crew just after, in post, take the AMAC from behind you and replace it with Sanders 2020, you would probably not approve of that. Is that what I'm hearing?
Yeah, definitely not.
We need to leave it there for now. Thanks so much for being on the show. It's been excellent. And you stay with us too. We'll be right back here with more coming up in a moment on the Income Generation.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks. But yet, you're still waiting to act. Visit the retirementincomestore.com today to regain control of your retirement.
While the Secure Act seeks to address some of the broad challenges facing American saving for retirement today, meeting those challenges is ultimately up to you. It's up to you to understand how the new law impacts your retirement plan and to work with the right advisor to take advantage of any opportunities it may provide. It's also up to you to stay abreast of ongoing changes in financial markets, which is something that we strive to help you do each and every week right here on the Income Generation. As you probably know, the stock market has experienced some brief bouts of volatility in the last month or so, attributed to uncertainty about the coronavirus outbreak. Now, in spite of this, the market rally that began last fall has continued, with the exception of just the last couple of weeks, with all of the major market indices hitting multiple new record highs since the first of the year. What's gotten less attention in the media, however, is the fact that the disagreement between the stock market and the bond market over the direction of the economy has deepened going into 2020 so far. While the emotional stock market has continued riding a huge wave of optimism, the bond market, which is driven more by logic, has become increasingly cautious, clearly demonstrating that bond investors are paying attention to certain issues that stock investors on Wall Street just seem to be ignoring. In addition to coronavirus, those issues include numerous signs of slowing global growth. In truth, the bond market began tightening up just as the stock market began soaring, from late October right through the new year. That's when the yield on the 10-year Treasury rate stabilized at between 1.75% and 2%. This kept long-term interest rates just slightly higher than short-term interest rates. Short-term interest rates, of course, were lowered by the Federal Reserve 3 times in 2019. And as you might recall, the Fed was basically forced to make those rate cuts after the long-term rates dipped below the benchmark short-term rate, creating this thing we called an inverted yield curve, which is a classic warning sign of a recession. So while Wall Street has continued to ignore that warning sign, the bond market has been taking it seriously. And since January, the 10-year Treasury yield has fallen even lower, hovering around 1.5% to 1.6% for a while, and very recently actually down below 1.3%. With the current Fed funds rate at a range of 1.5% to 1.75%, this puts the yield curve absolutely inverted once again. In other words, the more logical bond market now disagrees more strongly than ever before that the economy is actually strong enough to justify the soaring stock prices that up until 2-3 weeks ago we've been seeing in the stock market. This disagreement reinforces, for me at least, the likelihood that what we're seeing with the stock market is a classic blow off top, a period of relatively steady market growth that occurs amid mixed economic data. It's usually at the end of a cyclical bull market and is often followed by a steep correction. With that in mind, please remember there's much more to securing your financial future than taking advantage of changes outlined in the Secure Act. It requires a real understanding of market trends and market cycles, and of the importance of making asset protection your number one priority. Well, now it's time to have some fun, and let's get to some of your questions and comments. First up, we have Cosimo. I'm sure you know who you are. I'm sure we can't have a ton of Cosimos listening to the show today. Cosimo, you emailed us at theretirementinComestore.com, and your question was, Dave, I'm 64 years old, and I'm looking at using investing sites like Stash to invest in the stock market. Do you have any advice regarding this type of online site? Well, I'm not familiar with Stash deeply at all. My understanding of it is it's a website for people who are trying to get started investing and to do it cost effectively. I would believe, though, because most of these online websites don't really give you a ton of research or a ton of guidance. In other words, they might recommend of certain funds or ETFs what might be higher rated than another, but what it stops short of typically is explaining whether or not a certain type of fund or ETF is actually right for you. And being that this type of website being more of a starter thing, my assumption is that it's probably something designed more for people in their 20s or 30s or maybe early 40s. And at age 64, I would just be a little bit cautious about that, because at the end of the day, nothing replaces the personal touch of someone who can help you build a plan for your specific goals. Next, we have Dwight. Dwight writes, what are your thoughts on fixed annuities? Are there better investments than an annuity to get some income? Perhaps no risk to initial investment? Well, you know, annuities are one of the most controversial things out there. I like to say they're the good, bad, and the ugly. And the reality of it is, to get income from an annuity, yes, it's guaranteed for life, and yes, the income that's guaranteed for life could be higher than some of the things we talk about right here on the show, known as the universe of bonds and bond-like instruments, as I like to refer to them. But almost by definition, with annuity, the reason you're getting higher, quote, income is because it's not all income. It's income and principal. So it's not going to protect your principal with most annuities as you take income from it. Now, if you don't take income, certain types of annuities could be quite safe. But if you're taking income, then by definition, you're drawing your income and your principal. And that's why the guaranteed cash flow you can get forever, guaranteed for your whole life, whether you live to be 110, is usually much, much higher, because it's income and principal. Again, not good or bad. The question is it right for you and for your goals? And finally, we have Michael, who writes, Dave, I watch your show most all the time. First of all, Michael, thank you for that. I appreciate our loyal fans. And I'm a big believer in your program. I'm 69 years old and have a middle six-figure retirement account. Let's call it $500,000 or so. Guesstimating. Both my wife and I have Social Security and retirement accounts from our employers. We have not really dipped into the retirement fund yet, but pretty soon we'll have to because of RMDs. Over the last couple of years, I've developed a couple paper portfolios with stocks, closed-end funds, and bond ETFs that are throwing off $18,000 to $25,000 in dividends. Based on the $300,000 to $500,000 in the paper portfolios and the balance of the account, with RMDs kicking in, will it be possible to not draw down on principal without huge risk? Your thoughts? Well, you're off to a great start. I have to commend you, Michael, because what you're doing is you're getting about a 5% income flow. 18,000 on 300 is a little more than that, and of course 25,000 on 500 is about 5%. And your RMDs don't get over 5% until you're 78 or 79 years old. So if you live long enough, the RMDs will always exceed the interest and dividends. At some point, the RMDs are more than 10% per year of your account. But you've got the right thought process. The only thing that I'd recommend you consider tweaking is, instead of closed-end bond funds and bond ETFs, consider the use, if you have experience, or if not, do it with the help of a professional, consider individual bonds and bond-like instruments. Because remember, when you buy an individual bond, you have two important guarantees. You have a guaranteed lifetime income for the life of the bond, and you have a guaranteed repayment of the principal when it matures, provided, of course, there's no bankruptcies, corporate bankruptcies, or defaults. When you buy a bond fund or a bond ETF, neither of those guarantees exist. So when you buy a bond fund, what you're actually buying, and this is how it's actually defined by the SEC, so if you were studying to become an investment advisor, you'd read this, that the definition of a bond fund is actually the stock of a company that owns bonds. It's actually riskier than a diversified portfolio of individual bonds. So Michael, I give you a lot of credit. You're thinking down the right path, but I would just consider that one important tweak. Now it's time to thank all of our viewers who reached out with their questions for me to answer. If you have a question or you want to weigh in on today's show, we want to hear from you. Reach out to us on the phone or send us your comments in an email, and you could hear your questions answered right here on the show. We'll be back with more coming up right after the break.
Whoa.
Damn.
Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan. Now, while it's great that the Secure Act gives you a little more time before having to start worrying about RMDs, it doesn't mean that you should put off preparing for them. As I've noted many times on the show, having the right strategy in place to satisfy your RMDs is one of the most important components of a successful retirement plan. Remember, RMDs start at just about 4% of your IRA balance, and they increase each year as you get older. Also remember that the penalty for taking insufficient RMDs is a whopping 50%. Once you've properly calculated what your RMDs will be, the most important thing to consider is whether you have the right asset allocation to satisfy them. What do I mean? Well, in my experience, an allocation right for taking RMDs should be able to generate at least that 4%, but not in total return, 4% in dividends or interest, 4% in income. If you're earning less than that in dividends or interest annually, you may end up using the worst possible financial strategy, and that is having to sell shares of a mutual fund or stocks each year to satisfy these RMDs, these forced government withdrawals. This, as I've explained before, is one of the most common and potentially disastrous mistakes that retirees can make with their money. Here's the bottom line. Even though the new Secure Act gives you some additional time before these RMDs kick in, the sooner you adopt a sound strategy for satisfying them, the better. That means a strategy that protects you from the risk of spending down principal and from the kinds of devastating losses many Americans suffered with the two major stock market corrections that occurred since the turn of the century. So if you're a regular viewer, you know I believe that a third major correction is not only likely, but long overdue. That's one of the reasons I created the Retirement Income Store, a resource that helps investors nationwide find a financial advisor uniquely qualified to help them try to protect their money through financial strategies geared toward trying to secure principal and creating reliable, lifelong income. And now it's time to welcome our very good friend, Brad Williams. He's the owner and president of Brad Williams Financial Services, a retirement income store located in Huntsville, Alabama. Brad, thanks so much for being back on the show with us today.
Well, thank you for having me, Dave. I appreciate it.
So pick out for our viewers, if you will, what you think is maybe the one greatest benefit of the Secure Act, as well as maybe the one biggest negative of the Secure Act in terms of how it affects your typical client.
I think the biggest is the fact that RMDs got delayed to age 72. I can't tell you how many times when I meet with people and we're beginning that process that they say, I really don't want to take this out of here. I just have to. Is there any way I can not take it? And I say, that's just the way it is. So that's probably the biggest bonus is the fact they get to delay and, not have to draw down until 72. Biggest downside is the stretch, which is probably, the number one thing that a lot of people like when they're passing access to grandkids is the fact they can take it out over their life expectancy. And now till they, it's got to be 10 years.
So are you relieved now? You don't have to explain to clients this crazy 70 and a half thing that, if your birthday was July 1st, you get another year. If it was June 30th, you have to take it this year. That makes our lives a little bit easier, does it not?
Oh, you're not kidding. Because even when I describe that, Dave, they're still, you can tell the deer in the headlights for most of them. They just basically default to, well, you're going to help me with that, right? And I'll say, yeah. And then they say, okay, that's great. So yeah, I agree with you. It makes it a lot simpler.
And the benefits being able to take money out tax-free for certain things, that's a big help for some people. Again, student loans today student loans are such a big issue that we actually have a socialist at the top of the Democratic Party this time, in big part because of his stance on student loans. So just the fact that those can be paid off with tax-free withdrawals is a big plus, is it not?
Yes, it is. And I actually had several years ago a client adopt a couple of Russian orphans, and they had to take money of their IRA, and they paid the penalty because they were too young, but they could have gotten around that for that very reason. They just wanted to do it bad enough that they didn't mind paying the penalty.
Mm-hmm. Sure. Any last minute thoughts in the 45 seconds we have left in this particular part of the segment for our income generation viewers? Any last minute thoughts about the Secure Act and what they could do to really improve their financial situation now, given a little more flexibility?
Well, I think all in all that the pluses outweighed the minuses. I know statistics show that a lot of people don't actually do the stretch, so losing the stretch is not that big a deal. But the delay to 72, that's a big deal for a lot of people.
Yeah. And for people who are working, the fact they can still make IRA contributions past age 72 too, that makes it a little bit easier too for some. So Brad, stay with us. We're going to come back after a commercial break. We'll be right back in a moment, right here on the Income Generation, right after the break. Welcome back to The Income Generation. Now it's time to bring back my very good friend, Brad Williams, owner and president of Brad Williams Financial Services, a retirement income store located in Huntsville, Alabama. So Brad, I know we're talking about really the Secure Act today, but after what happened this past week in the stock market, coronavirus, Bernie Sanders coming to the top in the Democratic Party, let's talk about the markets. What do you see happening moving forward with the market? Could this be the tipping point? Is this the big tipping point? Or are we still going to have a rally through the election like most analysts thought through 2020?
Best case for the rally to continue, I think it's about 50-50. I think the market's been looking for a reason to pull back. I know a lot of people are on a hair trigger with the trade wars, with all the issues going on. And this coronavirus really stands to bring some severe downturn to the world economy because China makes so many things and they need them in supply chain. So this could be the push that takes us to the correction. It could be.
It could be a tipping point. How much of this do you think, in your personal opinion, is coronavirus versus the Bernie Sanders factor? I'm just curious.
I would say it's more coronavirus, but I think as time goes on and he gets closer to the nomination, there's going to be a lot of people that are really unsure about the direction because he's already stated his positions and they are not really good for business.
I love your sense of humor, as usual. But, I think you're right because when you worry about a pandemic, you expect a real flight to quality. And as you know, the 10-year Treasury yield has now gone lower than it was at the height of the financial crisis. So with that in mind, we've got 1 minute left in this segment. What's the best advice you want to give to our income generation members right now in light of the fact there's over a 50% chance that this is the tipping point for the next bear market?
Well, I think it's time to take a look at, depending on where you are in your retirement, if you're right at it or near it or in it, is taking a look at shifting from that growth asset you've come to depend on the last 10 years into an income producing asset that's going to be more stable and dependable. And that way you're not killing yourself when those RMDs come out that we were talking about earlier. So looking at stable and dependable income is going to be the key to making it through this crisis.
And at age 72, you only need to have really a 4% interest or dividend payment to satisfy those RMDs. And we all know somebody in Huntsville, Alabama, who knows how to get more than 4% in interest and dividends for his clients. So, Brad, thanks so much for being part of the show. I really appreciate you being here and contributing today as usual.
Hey, it's always a pleasure, Dave. Thanks a lot.
And you stay with us too. We'll be back here with more coming up in just a moment on The Income Generation. We'll be right back. I'd like to thank all of our guests for joining us today for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. Now, you don't need me to tell you that positive news coming out of the nation's capital can be hard to come by these days. The passage of the Secure Act is at least one exception. While no new legislation is ever perfect, the Setting Every Community Up for Retirement Enhancement Act is at least a step in the right direction in many ways. It confirms that lawmakers actually recognize some of the specific challenges facing Americans who are preparing for retirement in today's day and age. People are living longer than ever before, so the Secure Act gives you additional time to grow your tax-deferred savings before you have to start taking these pesky RMDs. People are working later in life, so the Secure Act eliminates the age limit for contributions to traditional IRAs and increases the maximum contribution rate for certain types of 401k plans. Increasingly, investors understand that the key to successful retirement planning revolves around income. So the Secure Act includes several provisions allowing for more lifetime income products inside retirement plans. It also includes new provisions for taking tax-free distributions from retirement accounts to help the millions of Americans struggling with student loan debt. While all of this is very helpful, the ultimate responsibility of meeting today's retirement challenges is still up to you as an individual. It's up to you to understand how these new laws may impact your retirement plan and to work with the right advisor to take advantage of any opportunities that they might provide. The right advisor can help ensure that you have the right strategy for satisfying your RMDs once they kick in now after age 72. They can help you find alternatives to a stretch IRA strategy and adjust your retirement plan in other ways, if appropriate, to accommodate the changes imposed by the Secure Act. They can also give you the peace of mind that comes from knowing that the income-generating strategies you have in place will continue to protect your principal and generate dependable income to meet your needs and goals throughout retirement. Thanks for watching. If you're close to retirement, you really want to know how to protect and maximize your money. As you know, it's essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.